In 1972, Buffett spent $25 million on a company, a price that looked ridiculously expensive at the time. But this single transaction completely changed his investment life. From this moment on, he transformed from a cigar butt collector into a bear of great companies. In 1972, Buffett made a decision that changed his entire investment approach. He bought Candies for $25 million. Why was this significant? Because Candies didn't fit his old strategy. The company had $210 million in annual revenue, $21 million in profit, and a 26% return on equity. But Buffett paid 3 times the book value. By old Graham rules, this was unacceptable. Munger convinced him this was a wonderful business with pricing power. The question wasn't whether the price was low. It was whether the business was good enough to hold forever. Candies could raise prices every year without losing customers. A box that sold for $1.95 could go to $2, then $2.50, then $3. Customers kept buying because the brand mattered more than the price. Buffett later recalled, "I learned from Charlie that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This single acquisition moved Buffett from quantity to quality, from cheap stocks to great businesses, from speculator to investor. This was Buffett's turning point in investing. From buying bargains to buying good companies, Candies proved one fact: a quality business can generate surprise return over the long term without continuously invest huge amount of investment. This was a revolutionary breakthrough of the Graham model. Before, Buffett believed good price plus ordinary company equals good investment. Now he understood fair price plus great company equals better investment. Remember, business quality matters more than price. A great business, even bought at a fair price, can generate great return. A mediocre business, even bought cheaply, is often a trap. Starting from $25 million, after multiple price hikes and brand expansion, Candies was valued at over $5 billion in 2022, a return of over 200 times. More importantly, it taught Buffett how to build good businesses, which became the foundation for Berkshire's billions in later investments. Candies' success tells us pricing power is the best moat. Companies that can raise prices every year without losing customers are true cash cows. To check if a company has pricing power, ask, can it raise prices without losing customers? If yes, it's a good business. $25 million didn't just buy a candy shop, it bought a new investment worldview. A good company is worth 10,000 times more than a cheap one. Remember, buying the right business is 100 times more important than buying at the right price.